Are you on the lookout for your next investment property? Smart Property Investment and Pure Property Investment have done the research for you on where the hottest up-and-coming suburbs for 2024 are and where you should invest for the best return. The report is completely free to download. Visit smartpropertyinvestment.com.au. Don't make any moves until you've read the report. Take your next step with all the facts, backed by research and industry experts.
This is a Momentum Media production.
Welcome to the Smart Property Investment Show, the podcast by investors for investors.
Hi, good everyone. How you going? It's Phil Tarrant here. I'm the host of the Smart Property Investment Show. I hope you're well. I don't know if you saw it. There was a big thing in the media the other day. 10 million downloads of this podcast since we created it many years ago, which is pretty good going. Sort of reminds me that by and large, I've got to get the commentary and narrative right, because so many people tune into this and use it as a way to sort of shape their view and the prism through which they view property investment as a wealth creation vehicle. We have, I get to speak to a lot of people right across Australia when it comes to property, those people who work in property and support Australian property investors. They come on the show and have a yarn with me. I also speak to a lot of property investors as well, which is really popular, people learning from other people's stories. And this idea of peer-to-peer learning is only sort of gaining currency across property investment over the time that we've been delivering this podcast. But just wanted to say thanks for everyone for 10 million downloads. I'll keep at it, keep getting it right. I don't always get it right, and I apologise if I do, but one thing I'm good at is taking on constructive feedback. So make sure you get in touch with the team editor at smartpropertyinvestment.com. If there's anything we're doing you like us doing and we want to do more of, let us know. If there's less, let us know as well. But I'm happy to report that most people don't hold their punches when they give me feedback, and that's okay. I'm a big boy. I can handle it. But it gives me a sense for just how the changing dynamics of property investment in Australia and the way in which, and I was only musing about this the other day, how the GFC was a great enabler for more Australians to take responsibility for investing decisions. I think it's a wake-up call for a lot of people that you can't expect other people to take charge of your financial future. You need to be responsible for yourself. The smart people I know are responsible, they're accountable, and they inform and they educate themselves to make better decisions. Listening to this podcast is just one of those ways they do it. It's a lot more accessible information when it comes to property investment. Once upon a time, you had to go and sit in a convention center somewhere and listen and tune in that way once a year. Now it's on demand. So whether the 10 million downloads is listening to us on the train or driving in the car or cutting your lawns or wherever you choose to do it, congratulations on investing in your education. We speak a lot about how you can champion investment in property investment. And myself, I'm a property investor first, probably podcaster second, or the other way around. I don't know, it probably changes any given day. When I'm happy about property, I'm a property investor first. When I'm not happy about property, I'm probably a podcaster first. But my job is to interrogate the ideas, the themes, but also with a view towards how I invest in property myself. And I go through different phases where I sort of reflect on what I'm doing, how I'm going, whether it's the right decision, the wrong decision. Am I achieving my goals when it comes to property investment? And, I don't even know. Sometimes if I have goals, I sort of want to make a few bucks out of property, but whether that's enough, I don't know. I'm sure there's some smarter people out there that tell me I'm doing it all wrong. And often, do I need a course correction? Do I actually need to change what I'm doing, seeing that I've been investing for property for some time? And if you're new to property investment, all this is coming your way. If you've been at property investment for a little while, no doubt you're sharing a lot of these same sentiments as I have right now. And the smart investor, says it on the name of the show, is always thinking about what they're doing, how they're doing it. Do you need to shift tact? What exactly is your end game? And if you're not thinking about this stuff, investing in property, you probably need to start thinking about it, because guess what? You'll get a better outcome. It doesn't need to consume you, absorb every act and action and part of your life, but you need to be getting yourself right cadence to actually understand how you go about having a relationship with your portfolio and how you choose to do it. Now, a lot of people, it doesn't come naturally. I'm fortunate because I get to pick up the phone and speak to anyone I want in property and get their feedback, but there's ways in which that you can concentrate on this and invest in this to push forward. And I want to have a bit of a discussion around that today, because there's many different ways you can invest in property Australia. A lot of people go it alone. They give it a crack. They jump on the realestate.com.au and have a look at property, and then I go and speak to a mortgage broker or directly bank, get some finance and buy a property. Usually those people buy the wrong property first, may get stuck for some time. Sometimes they luck out and give it a red hot crack. Other people choose to use a buyer's agent to do a lot of the heavy lifting. We speak a lot to them on this show. And there's some very good buyer's agents out there. It's a burgeoning part of the Australian property landscape, and there's some buyer's agents doing some really good work, but there's other people who can really support you on the educational side of things that can be a trusted confidant and a friend and a mentor through that process. And I want to sort of look at that as a way in which Australians can change, shape, mold, cajole their property investing journey so it is a good one. And there's two people joining me on the show. They've been at it for many, many years. I've spoken to them prior to this. I haven't had them on the show, I think, for some time. So I thought I'd get them back on and have a yarn. And these guys have been investing in property a lot longer. I haven't been in and around property. Simon Buckingham and Brendan Kelly, they're directors over Results Mentor. And you probably heard about these guys at some point in your pathway. Rather than buying properties for you as buyer's agents, they actually help you make more informed decisions around investing in property through mentorship and access and connectivity and ability. So the old adage of bringing horse to water and getting them to drink, they don't do it for you, but they help you invest in your future, take control, responsibility of your investing destiny through property. So we'll interrogate these things today, get a sense for it. And I've got 10 questions that determines whether or not your property investments will be successful. We're going to get into that as well. Simon, Brendan, apologies for the long introduction. How are you guys going?
Really well.
Thanks, Bill.
Thank you for the invitation.
Yeah, no, you probably get a sense for how I see the world, and no doubt I'm just like any other property investor that you get in front of. And I guess, one of my skill sets as a podcaster is I'm quite a curious character. So I'm quite keen to have a chat with you, and I'll probably frame it based on how I can get the best information personally I can get out of you. And if I do, I reckon everyone else will probably benefit from it. But Simon, at some point in time, most people will sit there and just go, why am I doing this, right? Like, why am I investing in property?
Yeah, that's right. I think most of us kind of fall into our property investing. We are told by an accountant or someone we know, or a family member, that property is a great idea, or your accountant might say you're paying too much tax, you're going to need to negatively gear a property to save some tax, or something like that. And we just kind of stumble into it, and we go out and we buy our first property. But the vast majority of us don't know really what we're doing it for. What are we expecting to get out of this investment journey? And how does this property even fit? We come at it almost like an accident. And then it may work out, it may not work out. We may get some way down our property investing journey and start to wonder, well, is this actually working for me? Why am I doing this? My property's going down in value, or my property's going up in value. Are they stagnant? How's that helping me move forwards? And what is it that I actually want to get out of this? So from our experience in mentoring literally thousands of people over the last couple of decades that Brendan and I have dealt with, and looking at the hundreds of portfolios, the properties that those people have had, the properties that they're thinking about buying, our own experience in buying and selling our way through dozens of properties ourselves, we've come to recognize that the importance of knowing, A, why you're investing, and B, whether the properties you're investing in are actually helping you achieve that goal. But it starts with that first question, doesn't it, Brendan? Why are you investing? And it's something that most people don't think about at the outset, is it?
It's interesting. Talk to a lot of property investors myself, and I asked the question, so what made you get into it? What was the inspiration? And there was I don't know, it was a good idea at the time. What made you buy this property? I don't know. I found it. We call this a ready, fire, aim approach. I want to become a property investor. I'll go to the bank. Have I got enough borrowing capacity? I'll look at my bank accounts. Have I got enough cash? I'll go to realestate.com.au. It's close enough to home. I can go and see it. Or, yeah, it looks like a good price and seems like a good sort of a house. It's solid. It's in a great location. You know what? I think I'll buy it. Now what do I do with it? Ready, fire, aim. The dilemma you face with that, of course, is without the aim, you don't know if it's going to serve you in the long term. There's a hope and pray associated with it, which is all about, will this serve me? And time is often a very big question that people don't consider. Typically, the story in the background is buy and never sell. And on the back of the buy and never sell approach, property prices will go up, rents will go up, ultimately the house will get paid down, and I'll live a retirement that is going to be okay or better than on super alone. And there's a lot of truth to that, provided you start early enough. But if you're later in life that you start, I wake up in your 40s, wake up in your 50s and decide to get into property at that age, then there's a whole I don't know if I've got the time to achieve this, pay the loan out, get the growth I need and the rental income I need to be able to live the life I want and supplement super. Or it could be I'm ambitious at 30 and 40. I want to be out of work in 5 to 10 years. And if you buy something as a buy and never sell approach, 10 years isn't enough time for you to hand in your resignation, never to need to work again. So there's a whole perspective that needs to be, or that we would encourage that you attach to your property investing activity, so you got a clue about the outcome relative to your investment. If you can figure out what it is you want, then you buy accordingly. If you go in with no plan, then there's a whole hope and pray approach that it works out okay. And unfortunately, we've seen in many circumstances that it doesn't. It becomes a very flat finish. It becomes a very low growth finish, and we don't get the outcome that we're after. And that can work against us if we're not careful.
Yeah. Whereas if you actually understand why you're investing in the first place, it shapes all of the decisions that you make, because every property investing decision is predicated on, will this help me achieve my financial goals? If I know what those goals are, I can make more informed decisions about what property to buy, where to buy that property, what strategies to apply, and so on. So I'm directed towards achieving my outcomes rather than hoping and praying that I'll somehow randomly get there.
So it's okay, though, Simon and Brendan, to start investing in property with a goal of knowing that it's probably a good thing to do and then fixing it and evolving it over time, right?
Yeah, we do applaud the activity. It is far better to be in the market than not in the market.
That's right. Action will always beat inaction. It's just obviously helpful if that action is informed and directed towards a specific outcome.
And targeted.
And goals change over time as a property investor. And you must see it all the time. I can probably going to buy 2 properties and that'll be enough. And then people get hungry and they see it and they see the upside and absorbs what they do, how they do it. It impacts and affects positively their decision-making around it. And then they start sort of going down that pathway. You must see it all the time. So this idea of the 10 crucial questions that tell whether your property investments will deliver on your financial goals, this first thing is, what was your plan? The first question is, what was your plan for the property when you bought it? Now, that will change over time, and you need to rethink every time you buy a property as you add to your portfolio. But I think the best way, guys, for us to get through this is, I've got 10 questions I want to ask you about it, and I'll get your sense on it. I think that'll be a really good way for us to frame and shape this podcast. So this second question is, do you have a growth or income targets to know how well your properties are performing? This is key, isn't it?
Yeah, absolutely. See, most people don't. And, bought a property and you ask people that, well, how's it performing? They have no idea because they don't know what to measure that against. So it's critically important going into any property purchase that you set yourself some goals or some targets. What has this property got to deliver for me in terms of growth, in terms of income, and by when? In order to know that it's actually going to help me achieve my financial goals. So you've got to set yourself some minimum benchmarks for the required capital growth, the minimum positive cash flow if you're looking for income generation from this property, or the maximum negative cash flow that you're prepared to tolerate from the property if it's negatively geared, in order to have some sense as to how does this property fit with my financial goals. So if I can talk from a personal perspective for a moment, Phil, when I was starting out on my property investing journey, one of the things I had to consider, because my objective, and everyone's different, but my objective was to get out of my corporate job as fast as I possibly could. So I needed to supplement and ultimately replace that job income with income from other sources, cash flow from property, cash profits from property, as an example. So when I was setting my own targets, they had to meet certain goals in terms of that income or in terms of a cash profit within a defined time frame, because I knew that if I wanted to get out of my job in, say, 5 years, I needed to be meeting those objectives. So I couldn't just go and look at an area and go, hey, I think this area is going to be great for growth. I'm sure property values will go up over the next 20, 30 years in this area. I'll invest there, because my objective was to get out of my job in a short time frame. So I had to have targets around the amount of cash flow or cash profits that I could generate from those properties in a fairly short time frame. Without that, I'd never have achieved that outcome. And in reality, it took me maybe 3.5 years to get out of my job from actually making the decision to go down that path, which was really exciting. But having those targets and those objectives and working to those, selecting properties based on those, and then tracking the performance of the property against those targets made a massive difference. So, if you don't want to be random in your property investing, if you want to actually achieve your financial goals, you've got to understand where those properties fit. What are the targets they have to achieve to know that you're on track to achieving your financial goals?
Well, if we back this down into the very basics, property investing is all about money. It's all about lifestyle and money. There are two ways property is going to make money: in growth of value or in income it generates. They're the only two ways pretty much it does that. You can use it as a tool, like a stock item. I buy it, I add value to it, I sell it, I walk away with a profit. That's another alternative, another strategic approach. But in essence, it's all about the money. Now, a smart property investor is someone who recognizes the value of the money it can generate. If you buy randomly and you take little consideration into what you want to achieve from it, then you may be buying a property that, again, the hope and pray model, that yields an outcome, and it may not. So your return on your investment, the amount of money that you make from the money that you invest, is going to be relatively low, or lower than it otherwise could be. So the more you educate yourself around what it is you want to achieve, the more you educate yourself around what it is that your objectives are, the more aligned you can be with the property that you buy to give the outcome that you want. And that's really the essence of what we're talking about here. Buy well and monitor along the way so that you can see that you're achieving what you had intended to achieve at the start.
And course correct if you're not.
If you buy randomly from the outset with a hope and pray and a lack of goal, you can turn that around at any time. You can wake up tomorrow and go, you know what? Probably an idea for me to focus some attention on the money that I've invested so I can maximize the return on the money that I've invested to get the outcome that I want. What do I ultimately want? You can start that game tomorrow. You can start it before you buy. You can start it after you buy. But the importance is to start it. And as soon as you get a little clearer on what it is that you want, then you've got the avenue to go, okay, you need a tool to assess, am I doing okay with what I've got? And again, that's the portfolio analysis we're talking about here in the 10 questions. This is a question around, am I doing well with the properties that I have? Or on the basis of my plan, am I going to do well? What's the forecast that I'm going to achieve?
Or even more fundamentally, how do I know if I'm doing well?
Yeah, correct. It's a tool for measurement, progress along the way. So, Phil, you've declared you've got some properties. Have you got a portfolio of sorts or a tool for analyzing the progress, the returns you're getting relative to maybe what you want to achieve? Have you done that sort of work for yourself?
I have. I do it regularly when I need to, and then when everything's swimming along, I typically leave it alone. And, one of the reasons why, well, you talk about, Simon, you mentioned why you got in the property. One of the reasons why I got in the property investment was, as a journalist, I used to read all these stories around everyone becoming a property millionaire. And I went, nah, doesn't always work that way. So we started Smart Property Investment and went, you know what, let's start investing in property ourselves and warts and all show how it is. So I'm pretty dialed into it. But my metric for working out whether or not my portfolio is performing well is whether or not I'm annoyed by all the phone calls I'm getting from property managers with repairs and maintenance requests. That's when I go, well, something's not really right here. There seems to be a lot of this. I need to look into it. And the other thing is when I notice cash flow changes. And I think all Australians with mortgages against investment properties have seen that over the last sort of year or so with these consecutive rate rises where you've gone, hang on a second, there's more red than black as a result of this. So I probably need to pull the hood up and have a good look in there.
And therein lies the encouragement for today's conversation.
That's the encouragement of that conversation, because you go, okay, something's not right. I'm not happy with this situation. What do I do about it? And you can do this at any point in time. And again, you need to have this relationship with your portfolio to know the triggers when you don't need to worry about, when you do need to worry about it.
But it's not even waiting for the something's not right trigger. It's the, I just recognized I'm asleep trigger.
Yeah, which is okay. And we all do it every now and then.
Correct. It's sitting in the bottom drawer. I'm cool. Or maybe I'm not. I better check that. Yeah. Or you could do it as an objective. And again, we speak to our members around this. You can do it as a, you know what, let's look at this annually. Let's look at this every 6 months. Milestones like Christmas and financial year and changes. Yeah. You look at it every 6 months. Am I progressing the way I thought I'd want to progress with this? Is it performing the way I want it to perform? Am I up from where I was or down from where I was? And what decisions do I need to make accordingly in order to mitigate and maximize the return on investment from my portfolio?
Yeah. And these are these 10 questions, right?
These are 10 questions.
These are
That's
construct
exactly
for working out.
What was my plan for this property?
Yeah.
Excellent. What was the income target that I have? And it becomes then a tool for measurement against that. Yeah. We've got a template we create, which is all about this is where it's at. I've got this one, I've got this one, I've got this one, I've got this one. And I've got the same metrics on each of these properties. And I know from that, property one's kind of doing better than property two. Property three is performing really well this year. Property four's, that's a pile of warm stuff that's not that fertilizes the garden. So we get to know and make an assessment one property against another.
And do you make those tools available to people?
We do in a program, absolutely. I mean, our role is to support our members to have an insight and an analysis on their own portfolio. I guess if we boil it down again, two functions. One, what have you got and how do you make the best of it? Two, what are you going to buy and how do you make the best of that? These are our two primary objectives in the program that we run. Yeah, and the template that we've got, which is the portfolio analysis, is all about what have you got and how do we make the best out of that? And how do we support you with that?
So what I take from that discussion is there's got to be this universal philosophy of being dialed into your portfolio. You need to embrace that in order to be a successful property investor. Then you look at the machinations of that. And one is what I spoke about is that being reactive to your portfolio, going, something's not right, better interrogate. And then there's the proactivity about setting yourself an agenda for proactively looking at your portfolio at a cadence that you're happy with, weekly, monthly, whenever, quarterly, annually, right? So, and I think those two things should work in unison. And if you're intrinsically connected in with your portfolio, that should happen. Well, that should happen.
See, that's beautiful. If you do this as a cadence, as you suggest, as of regularity every 6 months, you don't get the surprise. Does that make sense? You don't get the, oh, it's not working. What do I do here? Because you've already forecasted that it might occur and you've already put plans in place to solve the problem. So it is the proactivity negates the reactivity. You don't actually have to be reactive because you know it's coming. And therein lies the invitation.
Yeah, being able to telegraph the future again to what smart property investors do. And, this third question around, has the property met your expectation for growth to date? You should be able to identify that through a process of doing this. And the point is that if you're proactive, you don't need to be reactive. Or if you're proactive, when you need to be reactive, you're going to be more decisive around your decision-making because you've already thought about it.
So the third question, has your property met your expectations for growth? And you would know that because if you monitor that on a regular basis, you'd be able to see that. I have an objective of this property growing by about this much relative to the market conditions. I foresee this occurring. And then as you monitor 6 monthly, even quarterly, along the way, you go, I'm actually achieving that target or I'm not. I'm performing better or worse. And what are the consequences to doing that for when I next assess my portfolio? Which leads then into question 4, which is, well, what are the growth prospects for the future? What can I see? Now, that's a different question entirely and does require some gymnastics around the statistics available that allows you to then forecast median price movement into the future.
Well, let's have a chat about that. We'll just go to a quick break beforehand. Stay with us, back in a moment.
Stop overpaying on your home loan. We understand that managing your finances can be overwhelming, especially as interest rates continue to rise. With access to 70+ lenders, our team of specialised brokers will find the best rates for your specific needs. Count on us to secure a lower rate swiftly, giving you the confidence you deserve. Book an appointment with one of our experts today to protect your financial well-being and secure your future. Call us now at 02 8866 2444 or visit our website at finny.com.au.
Welcome back, everyone. Phil Tarrant from the Smart Property Investment Show with Simon Buckingham and Brendan Kelly, the team over, the guys behind Business Results Mentor. You've been at this for over 20 years, right, Simon?
Yeah, we've been about 2 decades. We've been mentoring people in the property space at all levels, right from beginners, people who've never bought a property before, they're just starting out, right through to people who have multi-million dollar portfolios, dozens of properties in their portfolio, or they're doing large scale mixed use and commercial development. So it's been a fascinating journey being able to support people at every level over those past couple of decades.
Yeah, you must find it quite satisfying to see people sort of grapple with this idea of what the future looks like and take control of their financial future. And rather than being a statistic, they're actually someone who can create that lifestyle that they want as a result of property investment. And, that's why I think everyone tunes in this show that, when people go, I love property, you go, yeah, that's fine. You love the outcome of property is pretty much what most people love personally. But, these sort of first three questions we spoke about to get us to this fourth question, which what are your realistic prospects for growth based on did you get the growth that you wanted? Now, this is where you sort of start getting away from more philosophical sort of structural ideas into the mechanics of how do you actually work out properties that you should be buying in areas that are going to give you either that capital growth uplift or that yield that you want. From what I understand, you guys are pretty good at picking markets over the last couple of years. It's tough to pick the bottom depending on what's going on at any given moment. But, as well as the logic and the mindset around property investment, a big part of successful property investment, no doubt you see in your mentoring programs, is actually understanding markets and what information is available for you to actually make the right picks. That is helping people make the right picks themselves rather than making the picks for them. Brendan, this idea, this question of what are the prospects for growth? Well, unless you've got a goal, there's nothing really to measure against. So how do you guys frame and shape this particular idea?
Yeah, sure. So there's a couple of things at play here. One is if I've got a property, you're already in a market. One of the objectives you want to satisfy is where is this market going? Because if you want to be proactive for the greatest return on your investment, then one of the things you might need to consider is, well, if the market is looking to decline and decline significantly, then maybe it's better to get out and buy somewhere else where the market's looking to grow. There'll be changeover costs, and typically that's about 8% of the value of the property. But if you've got a 10% or a 12% growth forecast into the future relative to a 5 to 10% drop compared to something you're already holding, that is a worthwhile investment on into the future. So it's a matter of then in making an assessment of where the market is right now. But you can do that also for where do I buy now? What's my next property going to be like? If I can understand what's happening in the market for where I buy, I can buy such that I can find something where there's a short-term wave of growth that's going to give me a real kick in the equity pants to lift the value of the property and support the lag for increased rent over a period of 12 to 24 months after that. So I not only get my lift, but I'll get the cash flow to support it behind that shortly after. So being able to read the market becomes really, really critical. So how do you do it? Now, let's get into some of the mechanics about how you can do it. Generally speaking, there are three statistics you need to monitor, and you need to monitor with some regularity. Just like with all commodities, it's a conversation about supply and demand. And what we want to look at is what is the stock on the market? What are the number of sales or the measurement of demand? And how is that affecting price? Now, there are subtle variances between every suburb. So it's important to monitor those statistics in your suburb and monitor them for at least 6 months, 3 to 6 months, for you to get a bit of a read. What we're attempting to monitor is the change in the volume of listings and the change in the volume of sales and how that affects the change in the median price. So Phil, as an idea, if I've got a volume of listings that's, let's call it 15. So at the moment, I've got 15 properties on the market. If that listing volume trends down over a period of months from 15 to 14 to 12 and then down to 10, we've had a 33% drop in listings. We've had a decline in the volume of listings. Typically, with a smaller supply, we have a demand and an equal demand. We have an increased pressure on price. So what we'll see as a result of that is median price will lift in that suburb. Okay. If, however, we're monitoring sales and sales also comes down, then the relationship between supply and demand remains static and median price won't move. If we have the number of sales go down faster than the number of listings, then what we've got is less demand. And even though the listing comes down, because there's less demand, you'll see actually a significant less demand, more sales will have a significant fall in the property price. If we've got sales going up and listings going down, you're going to have a massive fall in median price. So it's a matter of measuring the relationship between the volume of listings and the volume of sales and the median price. And over a period of time, you'll get to see where the median price is moving. And the nature of that trend, the nature of that analysis will allow you to read the market and where median price is going for a good 6 to 12 months in advance, if you monitor it and monitor closely. So on the basis of that, then you get an idea of where the market might be going, irrespective of what might be happening in the city or the state or the country. Because at any one time, there's about anything between 5 to 15% of suburbs that are rising by around about 10% or more. But there are equally 5 to 15% of suburbs going down by 10% or more somewhere in the country. If you happen to have picked one of those, then that's going to hurt. If you've got one that's going up, that's going to serve you. And the relationship between listings and sales will support you in buying well and being able to read the nature of what you're heading into for the properties you already own.
So this is something that we've been analysing through our property predictions organisation for several years, Phil, and it's given us some real insights into being able to read and, more importantly, anticipate and forecast the direction of the market right down at the individual suburb level, which is obviously incredibly powerful because when you buy a property, you don't buy a property in a state or even a capital city, you buy it in a specific suburb. So what's important to you in anticipating, what your prospects for growth are over the next 1 to 2 years is exactly what's happening in that specific suburb. So we all hear about, Australian median prices going up, property prices rebounding over the last 5 months and so on. But that tells you zero about what's actually happening in the market where you own a particular property in your portfolio. So you have to look at that balance of supply and demand that Brendan's talked about in that suburb to be able to anticipate where is that suburb most likely to go over the next 1 or 2 years. And so that's been a very powerful tool for us to have at our disposal for our own investing and for our members to be able to do that sort of analysis at that level. And it is something that we'd like to share with the Smart Property listeners as well. One of the things off the back of the podcast today is an offer for Smart Property listeners to have an expert portfolio review with one of our team, where one of us will sit down, take a look at what you've currently got in your portfolio, how has it performed, and give you some real insights. And we'll draw from our property predictions analysis, give you some real insights on the specific suburbs where you hold property and what is our analysis suggesting is going to happen in those suburbs over the next 12 plus months. And that can give you either a real sense of confidence about those properties, or it might give you some insights into something that might need to change or defensive tactics you might need to put in place if it's not going your way. But being able to shine the cold, hard light of day on that and get those insights is obviously an incredibly useful decision-making tool. So for people who'd like to take advantage of that, they'll just need to jump over to our website at resultsmentoring.com. That's resultsmentoring.com/portfolio. So resultsmentoring.com/portfolio. Drop your details in there and we'll get in touch and make a time to actually do that portfolio review with you.
So that doesn't cost anything, because I'm sitting there thinking, well, information is power. With more information, you can make more informed decision-making. So you just pick apart someone's portfolio and go, good, indifferent, bad. You probably need to start shaping and changing what you're doing inside of your portfolio.
No judgment. It is what it is. All our role in this is to go, okay, our forecast relative to what you're seeing, these are the areas that you might want to improve on or focus some attention on going forward. We're seeing the market movement in this particular suburb favorable for you. So that's good. Congratulations. Or we're seeing this particular market unfavorable for you, and it might remain that way for a period of time. Under those circumstances, do you have the capacity to service that debt in a negative growth environment? I mean, one of the worst case scenarios is you've got a negatively geared property where the property is going down in value. You're paying for the privilege of losing money. And if you're doing that for a period of 24 months, how do you end up? So, you ask questions around that and inspire people to think differently on their properties. It's kind of like a hand-holding reality check on what it is that they currently own.
Yeah. And I think for our listeners who probably like the idea of doing this, sometimes you just need a scaffold or a way in order to do it. So look, that sounds like a smart smart businesses to be doing. I guess also, you would support as part of that process, this fifth question, which is, has the property met your expectations around cash flow today? So it's not only the capital growth component, and to the point, if there's an acceptance that you've got an asset that's going backwards in equity, which happens in property, nature of the beast, with a subsequent sort of negativity around cash flow, that could help you make those decisions. But, these things don't happen in isolation. It's capital growth and cash flow working in unison. Most people want good cash flow, positive cash flow, and capital growth. Some people strategically want negative cash flow for the purpose of tax, but I think most people want positive capital growth. So cash flow is a big part of the equation. And do you think a lot of people, it's a forgotten part of property investment, this fifth question around cash flow?
Yeah, it's a funny one that there's obviously a lot of talk out there about passive income and that kind of thing. But as you say, Phil, the vast majority of property investors are probably investing predominantly for capital growth, and cash flow often doesn't even enter into the equation, or it's a secondary consideration. Although I would hazard a bet that it is top of mind for a lot of people these days, given the increases in interest rates that we've had and the impact that is having on people's cash flow. And particularly for someone who's maybe on a low fixed rate at the moment, but is due to roll off that sometime soon, this should be of keen interest to them. This should be an area of real focus, because you need to understand moving forwards with your portfolio, what are the cash flows going to look like? How sustainable are those cash flows? And what's the impact of that going to be on the profitability of your portfolio moving forwards, which is really our sixth question. So question 5, has the property met your expectations for cash flow to date? How's it performed? If you've had a very low interest rate, maybe your cash flows have been quite nice, but was that part of your objective for the property? If you bought it for cash flow, is it achieving that cash flow, or are you getting those calls, Phil, from your property manager telling you you've got a $10,000 maintenance bill this month, or your tenants trashed the place, or they've done a runner, you've got extended vacancy, whatever? How's the cash flow performing to date? But equally importantly, in fact, more importantly, what is the impact of that cash flow on your profitability? So buying for growth is one thing, and that's great. But if your growth is being eroded or wiped out by heavy negative cash flow, what's the point? So you have to look at the two together. I can have an asset that's going up in value, but it's heavily negative cash flow. If I don't recognize the impact of that cash flow on my profitability, because why are we investing? We're investing to make a profit, aren't we? Then I'm only seeing half the equation. I have to look at it holistically. I have to look at both the growth prospects, actual achieved, and what I'm expecting to achieve moving forwards, and the cash flow performance. What have I achieved and what am I expecting to achieve moving forwards together to get a pretty good sense of what the actual profitability is of my portfolio, or of the individual properties in my portfolio. It comes back to a point Brendan made earlier. If you've got a property that's coming down in value and it's negative cash flow, you're paying for the privilege of losing money. And that's a great way to save tax. But the only way you save tax is by making an income loss, by losing money. So we really, as investors, our focus needs to be on building wealth, creating wealth, making money, not on just saving tax, because that's not how we build wealth. So we have to look at those two together.
Yeah, don't be scared about talking about profitability inside of your portfolio. One of the big misnomers in property investment is that people think negative gearing is a strategy, i.e. deliberately losing money for the purpose of saving on tax. No, it's a tax outcome. It's not a strategy. And I think a lot of people finally get that when they sort of get into property. A lot of people, to the earlier point, start investing in property because they accountant will tell them they're paying too much tax. And it's a nice way to sort of ameliorate some of those impacts of tax. But you want to make money in property, let me give you a hot tip. And, you want equity growth, you want good cash flow, and that gives you a sense towards property. But this is the seventh question, guys, around how much equity is currently tied up in your portfolio. A lot of people don't really know. And I'd say it should be front and center, because that's your end game, right?
Yeah, that's right. I mean, this is a really interesting one. People think about what they originally put into a property purchase. So I might have bought a property years ago for a couple of $100,000, and I put in a 20% deposit of $40,000. But that property over a period of, say, 10 years has gone up to $500,000 today. And if I've just had an interest-only loan, so I've never paid down the loan. I originally had a loan of, what would it be, $160,000 on that property. So say I've still got that loan. I've now got not $40,000, tied up in that property, but $340,000 tied up in that property because it's gone up from 200 to 500,000. So I've added $300,000 worth of equity. That is the money that I have invested in the property. And that is what I need to be looking at and going, okay, that's great. I've got that growth. And, you should celebrate the successes when you've increased your equity in that way. And that equity then is going to potentially enable me to do things moving forwards. But how hard is it actually working for me? So this comes to the eighth question as well, which is, okay, if I understand how much equity I've got in the property, which is the difference between what the property is worth today and how much debt I have on that property. So you subtract the debt from today's value, that's your equity. How hard is that money actually working for me? What is the return in terms of the combination of annual growth and positive or negative income that I'm returning on that equity, that I'm achieving on that equity? And don't make the mistake of measuring that against the original 40K that you put into the property as opposed to the $340,000 that you've currently got in it. So yes, we go for that equity growth. That's really important. We can't eat equity though. So it comes down to how we're using that equity. What is the return on that current investment in the property, which is the money I have tied up in it right now?
Yeah, the return on equity is key. And I speak a lot about the portfolio we've built inside of Smart Property Investment on this show. And we've been at it for 10 years. And I can't remember exactly the numbers. I think we kicked off that portfolio. We tipped about 200 grand into it to get going. Ended up being sort of like 20 or something properties. We pulled all that money out. So the portfolio owes us nothing. All the equity inside of the portfolio is equity through growth rather than the initial equity through capital sort of contribution to it. And that's a nice place to be, right? But the big question is, so you get a sense of return on equity and you can start getting infinite returns on equity if there's no initial participation equity into it. And a lot of this where people get a lot stuck with their portfolio and they don't know what to do. And probably when they start having a chat with guys like you, and you sort of touched on it very quickly, Simon, is your equity working hard enough? Now, this is a key point for all property investors. And I just want to drill down. We'll just go to another break. Stay with us back in a moment. Welcome back. Phil Tarrant from Smart Property Investment Show, chatting with Simon and Brendan over at Results Mentoring. Now, equity is good, but if equity is lazy equity, you're not really getting any benefits from that. And you'll hear this term a lot, lazy equity. Unless it's doing something, you probably want to deploy it. And it depends where you are in your property investment journey. You might be thinking about, not doing too much more property investment and turn that into cash and something to live on, or you might be thinking more about some sort of income being derived out of your portfolio, or you might still be in a growth phase. And if you are in a growth phase and your equity is lazy, it's probably holding you back quite a lot. So how do you work out, Brendan, whether or not your equity is working hard enough for you? And this is the eighth question and probably one of the most important questions.
We've had people come to us and say, hey, I have a property portfolio and I just want you to do an assessment on that for us, if you could, just to figure out where we're at. And we do. And what we've discovered from time to time is people would have $2 million worth of equity and a negatively geared portfolio. So they got $2 million earning them virtually nothing. It's like saying, I've got no debt, I've got a $2 million property and I'm giving it away. I'm letting people rent for free. Squatters, go help yourself. Have some fun with it. It is a lazy use of equity. How you make an assessment on that is to determine, is your equity yielding an outcome that you want in terms of both potential growth going forward in the short term, and then there's a bit more of a dream around that in the long term, but also in the form of cash flow that you're making. So what's the return? So Simon, return on equity, how would you read that?
Yeah, so basically you've got to take your, not so much what you have achieved, but you've got to look at what you are expecting to achieve over the next year or two to get a good handle on this. And this comes back to the earlier questions we talked about, what are my prospects for growth? What cash flow am I expecting over the next 1 to 2 years? Add those figures together or subtract negative cash flow from the anticipated growth, or in some cases it might be two negative numbers. But what is that return? And then what is that as a percentage of the equity you currently have in the property? And then you can measure that against other things you could put that money into. So question 8 is at what return, being the annual growth plus or minus net income, are you currently achieving on your equity? Work it out as a percentage and then compare that to even money in the bank. So, Brendan, if I had
Which is question 9. How hard is your equity working for you?
Correct. So we take your example of, okay, I've got a $2 million house. I've paid it out. Let's say it's in a flat market that's value's going nowhere. And I'm getting an inner urban Sydney or Melbourne house yield of about 2% gross, right? So net after expenses, that's going to be something more approaching 1%.
Near zero.
So great. I've got $2 million of equity and I can stand proud on that. But my property value is going nowhere. It's in a flat market that's a flat suburb. And whilst I've got no debt on the property, so I'm not paying interest, I'm only earning about 1.5% return on my $2 million. What would I get as a term deposit in the bank right now? 4% plus.
And you're going to get more than 1.5% as a term deposit in the bank.
No, and I get 4% plus with zero risk. None of those calls from your property manager, Phil. So I've got to ask myself the question, right, how hard is this equity really working for me? Depending on coming back to my original plan for my investing, what is my investing supposed to do for me? Is this working hard enough to deliver on that? Or could I have this money working somewhere else to work harder? And it's a concept we call the velocity of money. Is my money working as fast and as hard as it can do to deliver on the outcomes that I want in the shortest possible timeframe with manageable risk? Or is my equity getting fat, lazy, and slow? And do I need to be a little more proactive about how I'm using that if I really want to achieve my financial objectives? How hard is that equity working?
You mentioned earlier, Phil, the idea of time. And I think it's an important conversation to have. If you start early in your life, 20s, 30s, early 40s, and you start to buy property and again, you say you played for 10 years in the SPY portfolio, which is brilliant. You've got all your capital back. Notice, though, that your capital that you put in, you've got back, which is brilliant. But the equity that is in there is actually still equity that you own.
Yep.
And it is money that you can play with. And relative to that money, that is the asset that you own, is it working hard enough for you? Is there an outcome that you could be making a difference on your portfolio for to yield a different outcome and a better yield for your time and effort with the equity that you've got? But you're right. It comes down to age. As a young age, I want capital growth. The broader target, the plan A of property investing is get me into high growth suburbs first, get me into high growth areas first. I will sacrifice income to negatively gear the property in favor of my growth. Over a period of 5 to 10 years, depending upon the nature of interest rate movements, depending upon the nature of property price movements, you will get to a point where it becomes neutrally geared. Then you've got a point, well, do I draw down on equity and go again? Or do I just sit with the one that I've got? The vast majority of people sit with the one they've got. But to get to a positive neutral cash flow, then another 5 to 10 years down the track, you're in a positive cash flow environment. But while you're in positive cash flow, your equity's gone from 20% of the buy price to 50% of the buy price. And that is the reason why you're in positive cash flow, because you've got a lazy amount of cash available to you, yielding a small return, being the rental income in an area where there is low rental income and high growth. You'll then get to the back end of life where you're 60, 70 and you go, time to retire. I will live off the income of my property. You've bought a property in a high growth area that is predominantly, and again, let's call it inner city, remained at a high demand, high growth type area. Rental income and yields remain much the same at 2, 3 and 4%. And when you retire, you might have a $3-5 million property earning you 3 or 4%, when you could take that equity, stick it somewhere else at that time of life for a high yielding 10 or 12% and live just an awesome life from the one property or multiple smaller properties with higher yields. So it all comes down to the way you manage. So we're actually talking about the relationship of time, lifestyle, and objectives back to exactly the basis of today's conversation, back to what are my property's purposes? How am I going to best get the return from the cash I've got available, the properties I own and or want to buy to yield the outcome that I need at the stage of life I'm looking to play at?
Yeah. What you're talking about there, Brendan, and a lot of people don't really get this, but it's very, very simple. This is this intersection between strategy and tactics, right? What am I trying to achieve? And then how am I going to actually achieve it? Now, what am I trying to achieve? This is the planning, right? And that will change over time. Your plan always changes as you get older and your family changes, your ability to create money changes, all this sort of stuff, right? But the tactics allows you to shape that change and capitalize on that change. And you're sort of talking about here is your equity working hard enough? And you're painting the picture there. I talk about the utility of equity. And, within that smart property investment portfolio, I don't want to give too much away because I don't do a big thing on it, but we're selling off some assets inside of that portfolio
No. You can't sell. You never sell.
No, you're allowed to. Did you know? Isn't that
the rule? Isn't that the way everybody goes? Never sell, don't sell.
So we've held on these assets, western suburbs of Sydney, for a decade, right? The utility of the equity that's in that is pretty much exhausted to a level I'm happy about. So I need to redeploy that equity to give me greater utility, which means that I can keep it where it is right now. And these properties are, well, in the current interest rate environment, they'll probably come back a bit, but they're neutrally geared and will be positively geared in time. But I'm not getting bang for my buck. The utility of that equity sitting there, it's inherently lazy. So it needs to be redeployed somewhere to get essentially the same again. Deploy it into a market where you're going to get the same capital growth with a view towards, an appetite for some negative cash flow. I'm okay with that. It's all right. It sort of works, and that's essentially my construct.
So let me ask you a couple of quick questions.
Sure. Yeah?
What was the trigger for making the change? What was the trigger for addressing this?
Just this whole idea of why do we buy that? But all these questions we asked about, why do we buy that property? What we were trying to get out of it? And have we got there? Yes. So it was time to redeploy.
But what was the trigger? Because you were saying before, was it a reactionary event or is this a proactive thing that you're taking?
Well, the key trigger, two things. Number one is to try and streamline the portfolio a little bit. So less assets, higher value. So trading up a bracket. So shifting in this decade shift of the asset classes that I want to be investing in because of capabilities to do so was very much a catalyst. And a lot of that, to be fair, is just an environmental sense of just getting annoyed doing a lot of maintenance requests for properties which are probably at the back end of their tenure in my portfolio, just going, I don't want to deal with it. I just don't want to deal with it. I want less, want higher value, and I want to start working towards higher income growth in time.
Right. So can you see that you've, as you say, based on feedback from your real estate agents, a reactionary approach, but you've also got a proactive approach in that you're taking an assessment of where the market's at right now and looking to make change relative to what you're looking to achieve over a period of time. So you have an awareness of the goal and your objective. You have an awareness of the nature of the portfolio you've already got. You're monitoring the reactions based on things and circumstances around it. You're actually doing a great job from the perspective of managing your portfolio. My only encouragement for you would be if you do calendarized quarterly assessments or 6 monthly assessments so that you can go, all right, this is where it's at and this is what I'm seeing. And you get to then forecast what are the trends that we're seeing for maintenance? They're increasing. What are the trends that we're seeing for interest rate rises? They're increasing. What are the consequences of that? And you get to then have a plan in advance of the event that allows you then to take a greater control of the portfolio you've got. And that's exactly what we're talking about today. You're already predominantly doing it. The invitation is to take it to a level where you're actually more proactive about it. Yeah. And that's what the offer is.
And that's what the offer is. And you can go and check out what these guys are doing in relation to a good review of your portfolio. I would say in response to that, life gets in the way of the best laid plans when it comes to scheduled reviews of your portfolio. So I'm more of a reactive investor rather than a proactive investor. However, it's forgiving because the stuff that I invest in is good stuff. So there's a bit of a soft landing for me if I don't always get it right. And one of the reasons, investing in property intelligence store and a smart property investment show is to go, hey, look, you don't always get it right. You make mistakes. You can always fix most things as long as inherently the properties that you buy are good assets and you know why you're doing. And I reckon I'd score us pretty well in that regards. It wouldn't always score us great on some of the disciplines around scheduled reviews of it. Normally it's just when I get annoyed with it when I pick it up, but that's my particular thing.
So is there a benefit? Can you see a benefit if you were to stick to the disciplined reviews of a quarterly or every 6 months? Can you see that there'd be a benefit in managing that?
Absolutely. Absolutely. And I reckon I would have a better cash position as a result of it. A lot of that is, I would even say, we haven't really spoken about it, but a part of the process is just not interrogating the assets that you have. It's the debt connected with it. And I'd say that's where I probably score us the worst, in that I only start looking at mortgage rates when I get annoyed when they keep going up. Then I sit there and I go, I don't want to sit on hold to a bank for an hour to speak to someone to be told that they can't change my interest rate. It's painful. And I normally sit there. When I get annoyed is when I go, I want to have a fight with a bank, is when I normally get on the phone and have a yarn with them. To be fair, I normally get a good result as well. But, and the problem is, this is the problem. When you end up with a big portfolio, the administration around it, just be careful what you wish for as a property investor, right? If you want to invest in property and you want to try and make good dough in property investment, you've got to spend the time, energy, and effort into making sure you're doing it. And you've got a construct here of 10 questions that can help shape it. And I recommend that you have a chat with these guys to actually interrogate this a little bit more. But it all comes back, I guess, around this out, the ultimate question, right? And I think about this all the time. If you saw the same property advertised today, priced at its current value with the same cash flows and growth prospects, would you buy it? Going back to my version of the stuff that I'm selling right now, I wouldn't buy it. Not right for me right now, but I'm sure it's right for someone else at a different part of their journey. Fair?
Yeah.
Simon?
Absolutely.
Absolutely. And the line in the sand is this ultimate question. As you declared it, it's the ultimate question. If I saw the same property advertised today that I currently own, in the condition that I currently own it, priced at its current value with the same cash flow as it is right now and the same growth prospects in the area that I own it, would I be excited to own it? Would I be excited to buy it? And if the answer is no, then the question is, well, is it wise for me to actually hold it? Would there be value in me selling it, moving on it, and getting something I would be excited to buy into right now?
Yeah, hence the reason why we're shuffling the deck, Simon.
Exactly. Ultimately, could you be getting a better return on the money currently tied up in this property? And that's exactly the question I think you guys have been asking yourselves, Phil, in coming to the conclusion that you're going to recycle some of these properties to put it into something that's going to give you the financial outcome that you're looking for, as opposed to just, doing more of the same or keeping these with the equity that they've built up in them.
Yeah. Well, it's time for us to get rid of these properties. Do it again. That's a good thing. I've still got a few more decades investing in me. So I'll be proactive around it. But I take the point, gentlemen, to maybe be a little bit more proactive. That's it. But
and young man, plan for them.
Plan. Don't worry, I'm planning. I've got a lot on. But no, I enjoy the chat. So if people want their portfolio reviewed by you guys, I think you mentioned a URL before, Simon. What do you do?
Yeah, so if you'd like to receive a free portfolio review from one of our expert property mentors, which will include exclusive analysis of the local suburb market outlook for the suburbs where you currently hold your investment property, so you can get a real insight into where those markets are going, and also get some of those tools that we mentioned earlier, such as a spreadsheet that will help you track and monitor your portfolio over time as well, then just jump onto resultsmentoring.com/portfolio, drop your details into the form at that address, and we'll reach out, make a convenient time to do that portfolio analysis with you.
There you got it. Nice. Enjoy catching up, guys. We're going to see each other again a little bit later in the year, I hope.
We are looking forward to it.
Yeah, it's good. Well, I'm going to do a couple of podcasts around these assets we're selling, and essentially giving a construct to how to approach those things. But to me, it's all around utilities. Utility of time, it's a utility of equity. It's a utility of capability, utility of knowledge, right? It's what all the best property investors do. They're able to pull all those things together, and hence the reason why a lot of people turn to you guys as mentors, where you can sit there and sometimes be nice and sometimes probably not be so nice. So that's okay. That's okay.
Smack about the head is required.
That's a nice, and you need it. Yeah, you absolutely need it. It makes sense to have someone else looking at what you're doing. Military do it's called red teaming, right? You go, everyone wants the same outcome, but you want someone to challenge you. That's how you get the best results. Simon Buckingham and Brendan Kelly, directors over at Results Mentoring. Go and check out that URL if you want to take advantage of that very kind offer from the guys. Hope you enjoyed this discussion, everyone. Remember to check out smartpropertyinvestment.com.au, social media, Smart Property HQ. We'll see you again next time. Until then, bye-bye.
The information featured in this podcast is general in nature and does not take into consideration your financial situation or individual needs and should not be relied upon. Before making any investment, insurance, tax, property, or financial planning decision, you should consult a licensed professional who can advise whether your decision is appropriate for you. Guests appearing on this podcast may have a commercial relationship with the companies mentioned.